The Federal Reserve just cut its rates this week, and this is supposed to be good for everything, most of all, the stock market. But is this true? Well, no one can say for sure. We can't tell the future. What we can do is go back and look at how share prices have performed whenever the Federal Reserve has cut its rate or rates. This question was brought to the forefront straight away yesterday by FedEx. The company announced troubling results and was punished for them. The stock down almost 15%, even though the Fed cut rates 2 days before. Now, the reason shares were axed happens to be the same reason why the Fed did what it did. In other words, the issue here is very timely. With questions swirling around the economy, can this bull market last? Does it get some additional legs from Jay Powell? We know because all the evidence shows it. Federal Reserve policy itself does take into account share prices, or really the index values. Policymakers don't want equities to potentially add another burden, especially during periods where there is already trouble brewing. Now, you've no doubt heard of the Fed put, which used to be called the Greenspan put. So we're going to take a look at how effective it has been in the past, whether or not it even exists. And while every financial advisor on the planet will tell you past performance does not promise future results, we can draw some very reasonable and solid conclusions where it comes to the big picture background, stocks, and the Fed. To give you an immediate sense of the stakes, we start with a timely reminder from the company formerly known as Federal Express. At least the CEO there didn't use the phrase macro uncertainty. Instead, he specified it as a, quote, weaker industrial economy. Shares were hammered even after the big-sized rate cut from Jay Powell. In fact, what FedEx reported is, as I said, the very reason why there was a 50 to begin with. It isn't about stocks necessarily, but understanding that shares can become very sensitive to the recession question. So if the Fed can boost the stock market in the short run at the very least, policymakers will definitely opt to do so. Well, according to CNBC on Friday, CEO Raj Subramaniam said industrial demand was softer than expected. Shipments between manufacturers and other companies in that segment are the most profitable for FedEx, which is often seen, here's the thing, as a bellwether for the U.S. and the global economy. Not just the U.S. economy, but the global economy too. Quote, the magnitude of the Fed rate cuts yesterday signals the weakness of the current environment, Subramaniam said, referring to the Federal Reserve's decision to cut interest rates by 0.5 percentage point on Wednesday. And here you have some truth from one of the big CEOs on Wall Street saying, yeah, the Fed cut rates because the economy's in trouble. And oh, by the way, we can see it here in our earnings. Instead of saying macro uncertainty, he said a weaker industrial economy, which fits with a whole bunch of data all around it, starting with employment. So the Fed cuts rates because of what FedEx reported. The question is whether or not it can be effective in the economy. Not so much. I've talked about that in previous videos. Rate cuts don't mean anything good for unemployment or the general economic condition. But as far as the stock market goes, there's a perception that it becomes invulnerable. When the Federal Reserve exercises its so-called put, share prices can only go higher from here. But is that actually true? And many people believe this has to do with the Fed's money printing operation. Well, at Eurodollar University, in our memberships, we talk about what is money. I have a whole basic series of videos where we talk about what is money, what is a bank. We have a couple of videos on QE and QT, and next up in that series, we're doing the basics on interest rate swaps. There's also Q&As, a weekly recap that I put together, as the name says, every week. I got 30 classroom videos where we get deep into how this Eurodollar system really works, where the money really comes from, and what it is supposed to do. All that's available, including the information on these Eurodollar University memberships, at our website, Eurodollar.university. But the stock market. Everybody wants to think about the stock market and rate cuts for very obvious reasons. And there is this widespread perception that the Fed is effective with its rate cuts in stimulating the stock market, which may be the reason why people believe that stocks go up all the time when the Fed acts. It could be just a self-fulfilling prophecy. But what does the history show? Well, the last time the Federal Reserve cut rates, That was in the middle of 2019. If you remember the time, 2018, the Fed was hiking rates because it thought the economy was becoming overheated, red hot, inflation, all of that. And then the market said, no, the economy is actually going in the opposite direction, heading toward recession. We got inversions. We got a big drop in interest rates, market interest rates, long before the Fed did, because that's what happens all the time. And so by the time we get to July of 2019, the economy is already questionable in many ways, like what we see now, although what we see now is far and away worse than 2019 in every respect. And the Fed says, okay, we see it too, let's start cutting rates. But how did the share prices, how did the stock market respond to the 2019 rate cut cycle? Well, immediately, almost the day after the Fed decided to cut rates, the first time, July 31st, 2019, the S&P 500, we'll stick to just the S&P 500 here just for simplicity's sake. The S&P 500 immediately fell because in many ways the Fed's rate cut seemed to be confirming at least the risk of a recession was much greater than people were expecting at that time and anticipating at that time. But it only took 3 months for share prices to get back to where they were at the end of July 2019. And the reason was because they rocketed higher from October 8th. And that was when Jay Powell, in a speech, announced that the Federal Reserve, given what had happened the prior month, September 2019, in the repo market, in the federal funds market, unsecured funding, on October 8th, in a speech, Jay Powell announced that the Fed was going to be doing what he said was not a QE, but everyone took to be a QE, including share prices. What Powell actually said was, in no sense is this a QE, and the stock market immediately priced it as a QE. Even though they were only going to be buying T-bills, which is the worst thing they possibly could do, between early October and then middle February, by the time we start getting into the pandemic discussion, the S&P 500 was up 17%. But that wasn't because of rate cuts. In fact, the stock market ignored the rate cuts because of the recession risk. Instead, what drove share prices higher was the myth of QE. And that's something we keep coming back to, at least over the last decade plus. Rate cuts, not so much. QEs are what the market really wants to see. Going back before then, the cycle, 2007, 2008, the Great Not Recession. The Federal Reserve started out with a 50 basis point rate cut in September of 2007. In fact, it was the exact same day, September 18th, 2007. Stocks had hit their high on October 9th, so a little bit afterwards, share prices and shareholders were enthusiastic about the rate cut at first, but as you know the rest of the story from there, it turned out to not be as optimistic as many people have been pricing in the stock market. There was that whole global, not financial crisis, it was a monetary crisis, a widespread monetary panic. The economy suffered the Great Not Recession, widespread damage all over the world. Rate cuts didn't seem to help either the economy or the stock market. In fact, stocks continued to plunge all the way until March of 2009, and they wouldn't get back to their October 2007 levels until March 28, 2013. So it took 5.5 years to get back to where they were in the immediate aftermath of the first Fed rate cut in 2007. And again, what drove them was not rate cuts. They didn't help in 2008 and into 2009. Stocks have a very good correlation with quantitative easing. Not because it's easing, nor is it really quantitative, simply because people have believed in the idea that quantitative easing is money printing. And so they believe that money printing ends up in the stock market, so they end up buying in anticipation of that money hitting the stock market when none of that actually is true. So they turn QE from a myth into reality by being the money that they think is being printed by the Fed when it's actually just them allocating resources and their own savings into share prices, which is exactly what the Federal Reserve wants them to do. So QE is a very powerful signal to share prices in a way that rate cuts are not. Rate cuts were ineffective in 2007, just like they were in 2019, but QE, different story as far as the financial markets go, especially stocks, not so much the real economy. You can see this back in 2001 during the dot-com bust as well. The Fed began cutting rates on January 3rd, 2001 with a 50 basis point rate cut that was actually an intermeeting cut. And they actually cut again at the end of that same month at their regular meeting. By the time we get to January 2nd, the day before the rate cut, the S&P 500 was at 1283, which is down substantially. It's down 16% from February. So it had a pretty sharp drop up until early January 2001, which is one of the factors that Greenspan cited in talking about why they were going to cut rates at 50 during an intermeeting period. And by April 4th of 2001, so a couple months later, the S&P 500 is actually lower. It's down to 1103 on April 4th, even though there had been, by that point, 350 basis point rate cuts. So 350 basis point rate cuts and stocks are only going to continue to go down. In fact, they wouldn't bottom out until October of 2002, when the S&P was down to an incredible low of just 776 on the index, even though by then, the Fed had brought the federal funds target from 6.5%, where it was at the end of 2000, all the way down to 1.75%, 475 basis points of rate cuts, and share prices were down a little over 50%, almost 60% at the low. And there was actually 2 more rate cuts that followed because there wasn't much recovery following the dot-com recession. Unemployment continued to rise for several years, showing that the Greenspan put wasn't effective in the economy or in the stock market. Now, where this idea actually comes from is in the rate cuts, I won't call them cycles because there weren't really cycles, but the rate cut periods in the middle 1990s. We'll start with the one in 1998, the Asian not financial crisis, which was a rehearsal for what happened in 2007 and 2008. But faced with LTCM and everything going wrong with especially Japanese banks, in September of 1998, the Fed started a series of 3 25 basis point rate cuts that they did in quick succession that were done with by November of 1998. And the S&P 500, which was down pretty substantially from July 98 through October low, it was down about 20%. It rocketed higher from there. So as the Fed begins to cut rates, you can see the correlation at the very least, the idea that maybe these rate cuts are helping the share prices go much higher. And they were already back to their July high level by November 1998. But was that because the Fed's rate cuts was really supporting the market, or was it because this was the late 1990s in the middle of the dot-com bubble? And the dot-com bubble was interrupted by, very briefly, fears that the Asian financial crisis might spill over to the rest of the world. And rather than rate cuts being the catalyst for more buying, maybe it was the market realizing that this was an Asian-focused, that's where most of the damage was going to come out. Therefore, the U.S. primarily was going to be just fine. So was it rate cuts, or were the rate cuts simply riding the coattails of the dot-com era? And before then, we go back to 1994 and really 1995. Starting in 1994, Alan Greenspan had raised interest rates to try to head off inflation that wasn't actually there. And he thought maybe the economy was softening a little too much in 1995. And so by July 6th of 95, they started another series of 3 25 basis point rate cuts, which is where this comes from, that finished up by late January 1996. And as you can see here, the S&P 500, and really the stock market in general, there was no correlation whatsoever to the rate cuts, because stocks were continuing going up in almost a 45-degree angle in almost the exact straight line, regardless of what the Federal Reserve was doing, which is what we're really talking about throughout the entire 1990s. It wasn't the Fed, it wasn't rate cuts, it was the dot-com era. It was the dot-com bubble in the later 1990s. So there was no Greenspan put, but the Greenspan put was manufactured largely by policymakers and the media afterward. They said, okay, that it was the Fed's rate cuts that helped share prices get out of the 1998 crisis, when it wasn't that at all. So stocks didn't really correlate with the Federal Reserve and its interest rate cuts, but the idea became embedded in market consciousness, and it has been continuously updated and continuously referenced ever since then. It doesn't matter what happened back then, there's always the next time. And this is basically true of everything with the Federal Reserve and under its interest rate targeting regime. After they stopped being a monetary agent, a real central bank, long time before then in the 1960s and 70s, and Alan Greenspan actually admitted this several times in the 1990s and early 2000s, they had to invent another way of keeping the Federal Reserve relevant. So they raised and lowered the federal funds rate and then told everybody that it was responsible for everything that was positive under the sun. Why was there a booming economy in the 1990s? Because the Federal Reserve raised and lowered the federal funds rate a quarter point here or there? Why did the stock market continue to go up? Well, there must be a Greenspan put. He can control the market by raising and lowering the federal funds rate. All there was a correlation. A correlation between the Fed using it, the only tool it had available, and a period in economic history when everything seemed to go right. So there's the real correlation that you need to be aware of. In the 1990s, the late 80s and 1990s, the Fed seemed this all-powerful institution. All it needed to do was raise and lower the federal funds rate, and everything seemed to work out really well. But as we just went through in the 2000s, very different results. The Fed continued to raise and lower the federal funds rate, but it didn't seem to work out. What changed for stocks was simply the idea of QE. The idea of QE. QE doesn't actually print money, doesn't put money in the real economy. That's why the economic results have been really bad. They've been lacking from the very beginning. We saw that in Japan even before we got to the first QE in the United States. But the myth has taken hold in the stock market and has become self-reinforcing and self-fulfilling. As Robert Shiller had said in his Nobel speech in 2013, a key Keynesian idea is that the valuation of long-term speculative assets is substantially a matter of convention, just as it is with judgments of facial beauty, as Keynes himself had said. Whatever price people generally have come to accept as the conventional value, and that is embedded in the collective consciousness, will stick as the true value for a long time, even if the actual returns fail for some time to live up to expectations. If an asset's returns are carefully tabulated and disappoint for long enough, people will eventually learn to change their views, but it may take the better part of a lifetime. And people have decided that QE is money printing, therefore anytime the Fed does a QE, that's the real put in the stock market, then they need to buy stocks, and then they become the money printing that they think the Fed does. So if there is a Greenspan put, at least as far as share prices are concerned, it's not about rate cuts. Rate cuts are ineffective in the real economy, and they're ineffective in the 21st century because economic and market conditions have changed in terms of everything else. So it looked like the Fed had a Greenspan put, had the power and capability in the 90s, and not so much in the 21st century. That's why it had to go to QE to begin with. And QE has become this self-fulfilling prophecy, where people believe in it, so share prices rise because people believe in it. And as long as people continue to believe in it, share prices will rise. So the real Greenspan put, as far as the stock market is concerned, is when things get bad enough in the real economy that the Fed doesn't just cut rates, that's ineffective in both the economy and the market, they have to do a QE. As we saw in 2019 with the not QE that everybody took as a QE, share prices rocketed from there. So for the stock market, the recession risk that is embedded in rate cuts tends to be negative for shares. But as soon as the Fed does a QE, then things really change. Again, not in the real economy, but in the marketplace. But in that way, the stock market, rising stock market under these conditions becomes counterintuitive. It becomes the contrary signal. Share prices rise because of a QE, and QE shows up because the economy is already really bad. So share prices rising because of a QE are actually rising because they're signaling the economy's bad. Everything has been turned upside down. That's the real Greenspan magic. The real thing that the Federal Reserve does. Gets people to believe in the opposite of reality. So there is no Greenspan put, there is no stock market put from rate cuts. And rate cuts happen because, as Federal Express or FedEx has shown us, the economy has fallen off substantially. That's what rate cuts signal, not a Greenspan put. It isn't just the Federal Reserve that's talking about not just rate cuts, but 50 basis point rate cuts. I talked about who's doing that and who's talking about it in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's memberships. Thank you to all you members and subscribers. And until next time, take care.